They told you silver was boring, a relic, a sidekick to gold, a metal for coins and grandma's spoons. What if that was never true? What if silver was the fuse wire to the entire modern financial system and someone already lit it? What if the real story behind today's inflation, insane housing prices, and your disappearing savings is not just money printing, but a hidden, weaponized shortage of one industrial metal that now sits at the core of the new green revolution? Here's the part they do not say on television. A 1.1 billion ounce silver deficit was not the end of the story. It was the opening move. And the next chapter is a quiet technological shift called the silver carbon anode that turns silver from a cheap bystander into the most strategically important choke point of the 21st century energy system. That change did not happen in a vacuum. It happened in a market that has been deliberately hollowed out and shorted into the ground by a handful of bullion banks and shadow desks using unbacked paper derivatives and rehypothecation. The primary mechanism is the global silver suppression and rehypothecation scheme in the derivatives and over-the-counter lending markets, now colliding with a once-in-history spike in physical demand from silver carbon battery technologies. The big reveal is this. The same banks that engineered this decades-long suppression have quietly positioned themselves on the other side of the trade. Silver carbon anode technology is the pivot. Your energy transition, your electric car, and your green future depend on paying them whatever price they demand for the metal they artificially locked away. In other words, the energy transition is being built on an engineered silver bottleneck, and ordinary people are footing the bill. Before we unpack this, quick community check-in. Where are you watching from right now? Type your country or city in the comments so we can see how global this silver blackout really is. And if you are tired of filtered and sponsored narratives, subscribe now. This channel exists to walk you through the unfiltered truth of money, metals, and power before the next switch gets flipped. Now let us step back and see how we arrived here. For centuries, silver was money, not backing money, not tracking money. It was money. Empires measured power by how much silver they could pull out of the ground and stuff into their treasuries. The Spanish Empire sailed galleons loaded with silver from Potosi in Bolivia and Zacatecas in Mexico. They were not shipping industrial metal. They were shipping the balance sheet of the empire. Silver-backed coins, taxes, and wars. When governments wanted to cheat, they clipped coins or reduced the silver content. Does that sound familiar? In the late 19th and early 20th century, the United States went through what is called the Crime of 1873. Congress quietly demonetized silver. Silver holders were wrecked almost overnight. Gold stayed. Silver was thrown out of the monetary club. The official story was modernization, stability, and progress. The unofficial story was concentrating monetary power into fewer hands. Gold was easier to control. Silver was harder to corner globally. Does that sound familiar? Every time a metal becomes too democratic, too accessible to ordinary people, it gets sidelined from the monetary system. Instead, governments promote debt, paper, and promises. And silver gets pushed down into the industrial basement. By the middle of the 20th century, silver lived mainly in photography, small electronics, and some coins. But a new script was forming: derivatives. In the 1970s and 80s, we watched the first modern silver war live on television. Two billionaire brothers from Texas, the Hunt brothers, tried to buy as much silver as they could. They saw inflation ripping. They did not trust dollars. They wanted metal. At one point, they controlled or had claims on up to 100 million ounces of silver. The price exploded from around $6 an ounce to almost $50 by January 1980. Then the rules changed. Margins went up. Contracts were frozen. Paper games suffocated the squeeze. The Hunts were destroyed. The narrative was simple. Speculators are bad. The system is good. Does that sound familiar? What most people missed was what that moment revealed. The silver market could be controlled not by mines or mints, but by rule changes and paper contracts. That discovery changed everything. Over the next few decades, silver was turned into one of the most heavily manipulated and derivative-driven markets on Earth. You could sell silver you did not have to people who would never see it in volumes that dwarfed real mine supply. Meanwhile, another script was running in the background. The green revolution, solar power, electric vehicles, energy storage. The pitch was clean, sustainable, and free of old fossil fuel cartels. But what if the new energy system quietly recreated the same cartel dynamics using different metals? Lithium, cobalt, nickel, and now silver, thanks to high-performance silver carbon anodes that massively increase battery efficiency and energy density. We are told this is progress, neutral technology for the planet. And behind the scenes, a small group of financial institutions quietly positions itself at the choke point of the key material. Sound familiar? While you worry about groceries, rent, and student loans, banks like JP Morgan, HSBC, and a tight circle of bullion dealers have been playing multidimensional chess with a metal that powers your phone, your solar panels, your data center, and soon your car battery. The old story was silver as money, then as industrial sidekick. The new story is silver as critical infrastructure for electronics and for next-generation energy storage. And right in the middle sits a 1.1 billion ounce deficit, not over a century, over about 3 years. The Silver Institute itself reported that from around 2021 through 2023, the world ran a cumulative deficit of hundreds of millions of ounces per year, adding up to more than 1 billion ounces of demand that had to be filled from somewhere other than current mine production. That silver did not appear by magic. It came from hidden inventories, government stockpiles, exchange-traded funds, and unallocated accounts on the balance sheets of bullion banks. In other words, it came from promises made to people who thought they owned silver. Now think about your bank account. You do not have a box with your name on it. You have a claim. The bank owes you money. The system assumes not everyone will ask for their money at the same time. Transfer that logic to silver. For decades, banks and paper markets have built a system where one single ounce can be promised to 20, 50, sometimes 100 different owners through layered derivative contracts, leases, and rehypothecated collateral. On paper, everyone owns silver. In reality, there is 1 ounce in a vault, if that. This structure, overpromised claims against a thin layer of real assets, should sound familiar. It is the same structure under the 2008 mortgage crisis and under today's shadow banking system. Now, instead of subprime mortgages, the collateral is the metal that makes your sustainable future possible. And right as that house of cards reaches its limit, a new technology appears that radically increases silver demand per battery, the silver carbon anode. The official story of silver carbon anodes sounds clean and inspiring. Researchers have found ways to use silver carbon composite materials in battery anodes to dramatically improve conductivity, reduce degradation, and boost charge speed and storage capacity. Suddenly, silver is no longer just a tiny coating in a solar panel. It becomes a core active material in batteries that could replace or augment standard graphite and even some lithium designs. Think about electric vehicles with higher range and faster charging. Think about grid-scale storage that can actually handle renewable intermittency. Think about wearables, phones, and data centers running on denser, more stable power. In laboratory tests, some silver carbon anode designs have shown energy density improvements of 20 to 30%, with cycling stability far above older chemistries. In some niche applications, projections go even higher. That is huge. But these breakthroughs did not land in a neutral market. They landed in a system where annual silver mine supply is roughly 850 to 900 million ounces. Industrial demand is already around 550 to 600 million ounces a year. And rising, solar panel production consumes more than 150 to 180 million ounces annually, and investment demand can swing wildly depending on sentiment. Now add batteries. If silver carbon anodes are adopted at scale, even in a minority of electric vehicles and grid storage projects, conservative estimates add 100 to 300 million extra ounces of demand per year over the next decade. All this in a market that is already running annual deficits of 100 to 200 million ounces. The real twist is who saw this coming and how they prepared. While retail investors argued on social media about whether silver would ever move, certain institutions were doing something very specific. They accumulated physical silver quietly through off-of-exchange channels. They pushed down the price using leveraged short positions on futures and over-the-counter markets. They leased and relented the same bars multiple times to create the illusion of abundant supply. They lobbied for regulatory changes that made it easier to settle silver trades in cash instead of metal. In 2011, when silver again spiked near $49, exchange margins were hiked repeatedly. The rally was killed and the game reset. In the years that followed, investigations exposed traders at big banks placing fake orders in silver futures to move prices and then canceling them, a practice called spoofing. JP Morgan alone paid over $900 million in fines in 2020 for manipulation and spoofing in precious metals markets. But those fines were simply a cost of doing business. The deeper function of this activity was long-term price suppression in a market where demand was about to explode. If you knew that the world would need much more of a certain metal in 10 to 15 years, would you let the free market price it correctly now, or spend a decade keeping the price low, shaking out weak holders, building huge hidden positions, and conditioning the public to believe the metal is dead? Now notice another fact. Multiple silver exchange traded fund prospectuses openly state that in the event of a market disruption, they reserve the right to settle in cash rather than metal. Combine suppressed prices, oversold paper claims, and an option to settle in cash. When things break with a breakthrough in silver-intensive battery technology, and you have a blueprint for a massive transfer of wealth and control. The losers are anyone who thinks they own silver on paper. The winners are the entities that hold the bars. And in the era of silver carbon anodes, those bars do not just represent savings. They represent energy. Who controls the silver controls the throughput of the green grid. Who controls the throughput sets the toll. And when you follow the paper trail through commodity exchange vaults, exchange-traded fund custodians, and derivative books, the same few names keep appearing. The receipt is wilder than you think. Now let us break down the mechanics in simple steps. First, paper silver. Roughly 1 billion ounces of silver come to market each year from mines and recycling. Yet the amount of silver traded through futures and over-the-counter derivatives can reach tens of billions of ounces per year. Analysts estimate that paper claims sometimes represent 100 to 200 ounces for every 1 ounce physically available for immediate delivery. Imagine a concert arena with 1,000 seats selling 100,000 tickets. As long as most people do not show up, everything looks fine. That is the silver market. On the main futures exchanges, a single futures contract represents 5,000 ounces. Big traders can sell these contracts short without owning the metal. They only need to post margin. If they dump enough contracts into the market, they can hammer the price down without touching physical supply at all. This creates the illusion of abundant silver. Second, rehypothecation. A bullion bank holds 1 million ounces of silver. That silver can be counted as inventory, lent to another bank, used as collateral, parked in an exchange-traded fund account, and also sold to clients as unallocated silver where they have a claim but not a specific bar. Every time the rights to that silver are lent, pledged, or sold without segregation, a new layer of claims appears. On paper, multiple entities own the same silver. The financial system extracts fees from the same underlying metal again, and again while pushing the real risk of non-delivery down to the smallest and least informed holder. Third, engineering the deficit. From around 2021 onward, industrial demand, particularly from solar, accelerated. Global silver demand reached about 1.1 billion ounces annually, while supply remained near 1 billion ounces. Officially, that is a shortfall near 100 million ounces. Independent analysts, tracking flows out of futures warehouses, London vaults, and exchange-traded funds, estimate the real deficit was higher, closer to 200 to 300 million ounces in some years. Over roughly 3 years, the world burned through more than 1.1 billion ounces of above-ground, easily accessible silver. Total identifiable. Above-ground silver bullion might be in the range of 2 to 3 billion ounces. Draining about half of that in such a short window is alarming. Where did the metal come from? Exchange-traded funds saw massive outflows. Registered categories in futures warehouses dropped sharply. Private vaulting companies reported increased drawdowns as industrial buyers paid premiums for immediate delivery. Each ounce that left these transparent pools and entered proprietary industrial pipelines essentially disappeared from the visible market. Once silver is soldered into a solar panel or built into a battery, it is not coming back for decades, if ever. Now layer silver carbon anodes onto this trend. Rather than just coating solar cells with small amounts of silver, advanced batteries could require grams of silver per cell, multiplied across millions of vehicles and large storage projects. Even if engineers reduce the amount of silver per device, the scale effect is enormous. Billions of devices, millions of vehicles, thousands of grid-level batteries. The math is merciless. If silver carbon anodes capture even a modest share of electric vehicle and storage markets, the additional demand can easily swallow another 100 to 200 million ounces per year. Fourth, front-running the bottleneck. In a normal market, such a situation would send prices soaring. Miners would be financed, exploration would expand, and recycling would scale. New supply would appear. In a suppressed and derivative-choked market, the first reaction is different. Those who know that demand is coming but want to keep accumulating cheaply use paper tools to keep a lid on the price for as long as possible. We have seen the pattern. News breaks about increased silver demand from solar subsidies, electric vehicle mandates, or new storage technology. Retail interest spikes, premiums on coins and bars widen, but the spot price drops. Silver can fall 5 to 10% in a single day on no major news, driven mainly by futures selling. In 2020, during the global health panic, silver briefly fell under $12, even while physical products vanished and dealers charged huge premiums. How does that happen? Because the futures market, where the headline price is set, can be moved with leverage. Physical scarcity shows up as premiums that do not fully feed back into the quoted price. This separates perception from reality. Ordinary people see a cheap price and assume plenty of silver. Insiders see drained inventories and know time is running out. Picture a major bank at the center of this web. It has paid fines for manipulating precious metals, but has earned far more than those fines. It serves as custodian for large silver exchange-traded funds. It operates a big over-the-counter derivatives book in silver leases and forwards. It has visibility into industrial demand, including confidential contracts with solar and battery manufacturers. It also knows that laboratories and manufacturers are preparing for silver carbon anode implementation with pilot projects already underway. That bank will gradually reduce its net short positions, accumulate physical metal, structure long-term offtake agreements with miners, and arrange deals where industrial users lock in supply at fixed or capped prices that will look extremely cheap later. At the same time, research notes and media appearances from its analysts will describe silver as volatile and uninteresting. This is how you front-run engineered scarcity. By the time the public realizes silver is structurally undersupplied in a silver carbon world, these institutions already own the metal, control the warehouses, and write the contracts. Years of underpricing have discouraged exploration and new mine development. Supply cannot respond quickly when the crunch arrives. This is what engineered collapse looks like in commodities. It is not usually a single dramatic event, but a slow starvation of supply combined with rising demand from critical sectors. Fifth, cash settlement, the final rug pull. You might think that at least people who hold silver exchange, traded fund shares, or unallocated accounts will benefit when prices rise, but the legal fine print says otherwise. Many large silver funds and unallocated accounts reserve the right to settle in cash at the discretion of the trustee under certain conditions. They may delay or deny physical redemption during market disruptions. They may use sub-custodians who commingle metal and rehypothecate it. In a genuine physical shortage where industrial users and governments scramble for supply, it is easier to declare a market disruption, cash settle claims at a politically acceptable price, and lock the remaining metal into long-term industrial and strategic channels than to allow a flood of redemptions to drain vaults. If you are a policymaker or banker under pressure to protect national energy security and grid stability, you will not choose the path that lets retail investors strip the vaults. The moral hazard is enormous. The same actors who suppressed prices, oversold claims, and underinvested in supply now hold the levers that decide who takes the loss and who walks away with real metal. Once silver carbon anodes, advanced solar, and other high-intensity uses are locked in, silver stops being just a store of value question. It becomes a question of who keeps the lights on. When survival is at stake, paper promises die first. The permanent consequence of this mechanism is a two-tier silver system. In Tier 1 sit physical, vaulted, long-term contracted holdings, accessible to states, megacorporations, and the financial cartel at internal transfer prices that they choose. In Tier 2 sit paper shares and claims, accessible to everyone else, redeemable only in cash, at numbers chosen in the name of stability. We have already seen early hints. In 2021, during the so-called silver squeeze, retail investors poured into silver products. Within days, a major silver fund quietly updated its prospectus to warn that if demand could not be met with readily available silver, the trust might not be able to acquire enough metal. In simple words, there might not be enough silver. Futures warehouse stocks dipped, premiums jumped, but the system bent and did not break. Now imagine a world where annual silver deficits are not 100 million ounces, but more than 300 million. Silver carbon anode demand continues to ratchet higher. Mining supply stagnates due to underinvestment and geopolitical tension. At some point, the system must choose between defaulting on some financial claims or defaulting on industrial contracts. Everything about the structure tells you which one will lose. The public side, the perception management side, the spreadsheet side. The energy system cannot shut down. Your fund can. In that moment, the final transfer happens. Decades of suppressed prices, rehypothecated bars, and paper illusions collapse into a harsh reality. If you do not hold it, you do not own it. So where does that leave us? We are standing at the collision of three forces. A heavily manipulated and overpromised silver market with a 1.1 billion ounce deficit hangover. A global push into technologies that embed silver into the skeleton of our energy and information systems. A financial system addicted to leverage, opacity, and cash settlement exits when reality becomes inconvenient. In the 20th century, silver was downgraded from money to just a metal. In the early 21st century, it was caged inside a synthetic paper zoo run by a small cartel of banks and exchanges. Now, in the coming decades of energy transition, it is being quietly upgraded again from industrial input to strategic choke point. Your cost of living, your electricity bill, your mobility, and your access to stable power will all ride on that choke point. This is not about cheering for some price target. It is about understanding that our current system runs on borrowed time and borrowed metal. Denial is built into the architecture. We deny that a finite metal can support infinite paper claims. We deny that underpricing a critical resource for decades has consequences. We deny that institutions with a history of manipulation will suddenly become honest when the last easy ounces are gone. Technology does not wait for regulators or narratives. Every new solar installation, every new battery, and every data center upgrade quietly eats into the remaining pool of accessible silver. The faster we push the green transition without reshaping the silver supply chain, the harder the eventual snap. The next financial shock will not move at 2008 speed. It will move at internet speed. Derivatives can be repriced in milliseconds. Exchanges can halt trading with one button. Funds can update their rules overnight. Capital controls can be rolled out digitally in days. A global rush for real assets in a digitized and over-leveraged system will not be polite. What should you do with this knowledge? This is not individual financial advice. It is systemic advice. Question what you think you own. If it exists, only as an entry in someone else's database. Ask who benefits when a critical resource is underpriced for decades and then suddenly repriced under panic. Remember that the words green and sustainable are not just moral language. They are business models for familiar power structures. Most importantly, abandon the belief that they would never let that happen. They already did. They allowed 1.1 billion ounces of silver to leave transparent markets and vanish into the dark. They allowed spoofing and manipulation to run for years and paid small fines. They allowed cash settlement language to define what ownership really means. The silver carbon anode is not the cause. It is the catalyst. It takes an already fragile and overpromised market and wires it into the most protected part of the economy, energy. Once silver is energy, price becomes national security. National security has never cared much about your abstraction of ownership. We have walked this road before with gold windows closed overnight, with savings frozen, with currencies reformed at the public's expense. The only differences now are scale and speed. Are we wiser now, or walking the same path in better suits? If this breakdown opened your eyes to how deep the rabbit hole goes, share this video with someone who still thinks silver is just another metal. Post your thoughts in the comments. Do you still trust paper claims on real assets? And if you want more deep dives into the mechanisms behind your money, your energy, and your future, subscribe and turn on notifications. The next shortage will not announce itself as a headline. It will arrive as a bill you cannot pay.